Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now the second quarter of this year has been an eventful one. We had the Liberation Day tariffs in early April, the sharp rise in Middle East tensions in recent weeks, and now we have of course the upcoming expiry of Trump's 90-day tariff pause in early July. However, what I found interesting is that despite lurching from what seems like one crisis to another, global equities are up over 9% quarter to date. For me, at least, this helps illustrate why it's so important not only to get invested, but also stay invested. Pay attention, of course, to risks and respond appropriately, but it's very important not to get unduly derailed by them. Now, in the current context, is the equity rally set to continue and extend, or is the tariff pause expiry a concern that we should pay closer attention to? To discuss this and more, I'm joined today by Heung, Senior Investment Strategist at the CIO office. So welcome, Ray. Thanks for joining us today. So in our last episode, we had laid out our investment strategy for the second half of 2025. So let's follow up on that and say, look, are there any risk events that we should be looking to more in the near term, and how should investors be thinking about balancing that with our longer term outlook?
Hey, thank you, Manpreet, for having me. I will start by saying that volatility is actually driven by risk events, and it is actually the constant in the market. But maybe let me treat the question a bit and build on your opening comments by saying what we have learned so far from the risk events in 2025. And I guess the lesson we would be able to draw is that crisis and risk events haven't been really a lasting deterrent for the financial markets. For example, if we look at global equities, which actually have moved over 9% higher in quarter two, despite the Liberation Day-led sell-off, and global equity actually hit new highs this week. And for more recent political events in the Middle East, that definitely had raised fear, and we saw spiking in oil prices. But then the spike also quickly retraced to their pre-military strike levels.
Okay, so let's dig a little bit more into the risk events. Just looking ahead over the next couple of months, what are you watching most closely, and what would you recommend our listeners do?
Yeah, I think you have already alluded to it in the early part of your introduction. I think another potential risk event that coming is the expiry of the Trump trade truce. And we think this trade truce expiry shall play into our theme of a weak US dollar. And in that, we would recommend investors to use the volatility to add to our second half 2025 investment themes. First of all, is to take a diversified global equity exposure and limit excessive exposure to the US. In that, our short-term quantitative model actually remain bullish Japanese and UK equities, and also to the US equities. And this supports the case that major equity markets are set to retest or set new highs. And in fact, if we look at the past week, we have already seen NASDAQ and Asia ex Japan has set new highs. Continued pressure on the US dollar also means that we favor diversified global exposure. And we would also use any volatility to add to Asia ex Japan equity, which we are overweight right now. We expect gains to be led by China. But while there are some concern about potential new restriction on the semiconductor subsector, we view such risk as rather limited. Moving on to Europe, we saw fiscal expansion and also the agreement of NATO members to spend 5% of GDP on defense actually support our core holding view on Euro equities and a preference for the industrial sector. And in Japan, short-term technical and a pause in the BOJ to hike rates also support a core holding view. Secondarily, on bonds, and we suggest adding dollar and emerging market bonds on pullbacks. Now, despite Fed Chair Powell has shown little urgency to cut rates until he sees signs of easing inflation, U.S. bond yield have actually drifted a bit lower as economic data has been disappointing. Now, Trump also floated the possibility of nominating Powell's successor ahead of his term's end, and all these can bring volatility back to the US dollar bonds. And we would wait and add when 10-year yields rose about 4.5%. We would also add to emerging market local currency bonds on pullbacks, and we expect there is a chance of this in the coming weeks when excessively long investor positioning cools from its extremes. And one more thing on bond is that we prefer the 5 to 7 years tenor in terms of maturity profile, because we see this offers the best balance between maintaining exposure to falling yields without taking the excessive risk inherent in long-dated bonds. We also remain opportunistic bullish on the US inflation-protected bonds, or the TIPS, to help mitigate any volatility led by a rise in inflation worries.
Thanks, Ray, for that detailed overview. You touched briefly on Japanese equities. So for our listeners, could you expand on that a little bit and share our view on Japanese equities?
Yes, certainly. Japanese equities are core holding for us. We saw the grow-heavy Nikkei 225 index actually outperform the domestic heavy TOPIX index by close to 6% in second quarter in this year. While the cooling of tariff and the Middle East risk has led investors to seek growth themes and favoring the AI-related subsector. So we continue to see corporate governance reform, share buybacks, and these are very good supporting the still reasonable valuation in the marketplace. We see some risk popping up, so it's like the upper house election middle of July that could potentially induce some volatility, but we're actually more concerned about a stronger yen, as it could weigh more on the earnings growth. But having said that, we expect the magnitude of the yen appreciation to be contained, as the Bank of Japan is not really in a hurry to raise interest rates.
All right, thanks, Ray. Before we close this podcast, would you share a little bit more of a view on oil? I mean, especially we've had an eventful couple of weeks here in the Middle East. So any thoughts on oil and oil-correlated assets?
Of course. The crude oil prices actually briefly spiked to over 77 US dollar per barrel on June 22nd after the Israel initial military action in Iran. The market was fearing that obviously escalation in this geopolitical risk might disrupt oil supply from the region. However, what we have seen is that the price have been fully retraced as the ceasefire took hold. Now investors, I guess, are focusing back to the fundamentals, and the basis is that oil market remains oversupplied in the situation. On the upside, we saw U.S. commercial crude inventory last week with well below seasonal norms, and a seasonal pickup in demand shall help balancing the market over the short term. However, I guess a lack of complete output compliance within the OPEC members and prior reversal of output cuts, that would mean supply remain excessive relative to longer-term trend. So we expect oil price to trade around the current, 65 US dollar per barrel, which is also a forecast. In relation to this, I think we could touch on a little bit on Canadian dollar, which is partly driven by oil prices. We expect it to be range trading between 1.354 to 1.386.
Thanks very much, Ray. I think we can, on that range trading note, we'll bring today's conversation to an end. Thanks so much for taking the time to join us today. If I can just share the top takeaways from today's conversation. We did publish our mid-year outlook last week, but within that broader context, number one is that we do like diversified global equity exposure, and that, of course, might become particularly interesting in light of dollar weakness that we've witnessed and indeed expect. Second is that we do expect any, or witness any volatility in the coming weeks. We would use that within equities to add to Ajax Japan, and within bonds, consider adding to emerging market local currency bonds, two themes from our outlook. And third, of course, US dollar bonds really await a rebound in the 10-year back to about 4.5% before considering adding again, a third key message from our outlook. So we bring it to an end there. Thanks very much for tuning in this week, and we look forward to speaking to you again in a week's time.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.